When it comes to the MACD trading strategy, many traders, especially beginners, fall into a range of common mistakes that limit their profitability and increase unnecessary risks. And understanding these pitfalls is essential for anyone who wants to use the moving average convergence divergence effectively. One of the biggest mistakes traders make is relying solely on MACD crossovers as buy or sell signals without considering the overall market context, because MACD crossovers alone can often give false signals during sideways or choppy markets, leading to premature entries or exits. Another frequent error is ignoring the role of divergence, where traders overlook the subtle clues that MACD provides when price action and indicator movement are out of sync, which can often signal potential trend reversals or weakening momentum. Traders also make the mistake of misinterpreting histogram signals, assuming that every rise or fall in the histogram means an immediate change in trend, when in reality it only represents the difference between the MACD line and the signal line, so rushing trades based on histogram shifts alone can result in losses. Overtrading is another serious problem, as some traders believe that every MACD signal must be acted upon, ignoring the importance of filtering signals with other tools like support and resistance, candlestick patterns, or higher time frame confirmation, which usually results in excessive entries that drain accounts over time. Another common error is using the default settings of MACD 12, 26, 9 for every market and time frame without adjustment, because while these settings are widely used, different assets and time frames require customization to match volatility and price behavior. Otherwise, traders end up chasing unreliable signals. Many traders also fail to apply proper risk management, placing too much emphasis on MACD signals while neglecting stop losses or position sizing, which exposes them to high losses when markets move against them. A frequent psychological mistake is that traders often hold on to losing positions simply because the MACD has not yet crossed again, forgetting that market conditions can change quickly, and discipline in cutting losses is far more important than waiting for indicator confirmation. On the flip side, traders may exit winning trades too early when MACD lines converge slightly, missing out on larger profits by not considering the bigger trend structure. Overlooking multiple time frames is another flaw, since MACD signals on smaller charts can be misleading without confirmation from higher time frames that show the dominant market direction. Finally, many traders fall into the trap of treating MACD as a standalone system rather than integrating it into a broader strategy, which means they miss the added reliability that comes from combining MACD with volume analysis, trend lines, moving averages, or fundamental insights. By addressing these common mistakes, such as over-relying on crossovers, misinterpreting divergence and histograms, failing to adjust settings, ignoring risk management, and neglecting multiple time frame analysis, traders can significantly increase their chances of using the MACD trading strategy successfully and avoid the costly errors that keep many from consistent profitability.